Some of the best intraday opportunities appear right at the market open. When a stock gaps up unusually large, the move often cools off during the day. We built a systematic intraday strategy to trade that behavior. We backtested it over a 6-month period. During that time, the Nifty 50 returned just 3%, while the intraday reversal strategy delivered 34%, meaning this strategy delivered more than 10 times the benchmark return. I'm Kaushal, founder and CEO of Castlegate Capital, a SEBI-registered investment advisory firm that builds products focused on quantitative investment and trading strategies. In this video, I'll walk you through the exact rules, the risk framework, and the full backtest results. Each morning, the strategy builds a liquid universe from the Nifty Mid Small Cap 400. It filters for liquidity using volume and selects up to 400 stocks, so we are trading names where intraday execution is practical. At 9:15, the algorithm takes a snapshot of the live price and compares it to yesterday's close. The opening gap is calculated as the percentage difference between the current price and the previous day's close. Only gap ups are considered. If the stock is flat or gapping down, it's ignored. Next, it computes the stock's 14-day average daily gap using daily history. The 14-day average gap is calculated by taking the average of each day's opening move relative to the prior day's close over the last 14 sessions. This matters because different stocks have different normal gap behavior. For a stock to qualify, these conditions must all fire. The stock must be gapping up and the gap must be at least 0.50%. Today's gap must be greater than average gap 14. No re-entries. If we already traded the stock today, we skip. The stock must be in the active universe with valid live data. When all of these align, the strategy places a market short. Position sizing is consistent. Each trade targets roughly 10% of portfolio value. Quantity is computed from price with a minimum share floor. This creates an equal weighted basket of shorts when multiple stocks qualify. The stop is dynamic per stock. The stop distance for each stock is set using that stock's opening gap, so larger gaps are given more room and smaller gaps are managed more tightly. So if a stock gaps up 2.2%, its stop is wider than a stock that gaps up 0.7%. How the stop works for short positions. For every short position, the initial stop is placed above the entry price using the gap size as the risk buffer. Once the trade is live, the strategy keeps track of the lowest price the stock reaches after entry. As the stock moves lower, the stop is trailed from the lowest price reached since entry while still using the original gap-based risk distance. The stop can only tighten, never loosen. If price rebounds and touches the stop, the position exits. This is strictly intraday. Any open positions are force closed at 2:55. Every Castlegate strategy comes with complete documentation. Its structure, logic, and parameters are fully detailed in the strategy document, which you can easily access by clicking the link in the description. The strategy was tested from August 19th, 25 to February 12th, 26. Starting with a capital of 10 lakh, the portfolio grew to 13 lakh 41,000. The strategy generated a gross profit of 3 lakh 89,000 with total fees of 47,000, resulting in a net profit of 3.41 lakh. This translates to a CAGR of 79% over the test period. From a risk-adjusted perspective, the strategy recorded a Sharpe ratio of 4 and a Sortino ratio of 6. The maximum drawdown during the period was just 5%, and the strategy achieved a win rate of 55%. At Castlegate, we're open to helping you make the most out of our strategies, whether that means understanding their core principles, testing them hands-on, or entrusting our team to manage them for you. Connect with us on WhatsApp for personalized guidance, or set up a session with our team through the Google Meet link in the description below.